Welcome, furry friend! This is Tom's Diary. Do you want to start? If that's so, let's begin. Hello, I am Tom. Welcome to my diary. Let's proceed to Tom's Day 1. Day 1. The problem. Help Tom answer the minute case analysis of Binghamton Beverages Incorporated. Oh, I guess Tom's gonna solve an accounting problem. Shown in this slide are the cost and production data for Binghamton Beverages Incorporated. The standard cost summary consists of the unit cost per materials, labor, and factory overhead in two different departments, the mixing and blending. Shown in the slide is the production report. This can help Tom solve the problem. And finally, the cost data. This data shows the actual costs incurred in two different departments. Here are the items required to be solved. Let's help Tom solve the following items. 1A. Calculate net variances for materials, labor, and factory overhead. B. Calculate specific materials and labor variances by department. C. Comment on possible causes for each of the variances. Number 2. Make all journal entries to record production costs and work in process and finished goods. Number 3. Determine the ending work in process in each department. Number 4. Assume that 4,000 units were sold at $40 each. And number 5. What will you do as a plant controller? We're now at day 2. It's time to solve.
Let's start with the first item.
This is the calculation of the net variances for materials, labor, and factory overhead. From the data given on the standard cost summary and the production report shown earlier, the standard cost of production can be determined. To facilitate the comparison of the figures with the actual cost and to determine the variances, a format like this can be used. In looking for the variance, you only have to solve the difference between the actual and the standard or budgeted costs of materials, labor, and factory overhead. Moving on to the calculation of specific materials and labor variances by departments, this shows an alternative format, or sometimes referred to as the goalpost diagram. This is for calculating the materials and labor variances using the data previously presented for materials and labor. Under mixing department of the materials, the combined effect of the two variances results to unfavorable net materials variance of $1,600. Under blending department, we have 0 for materials quantity variance and then $275 for materials price variance, which is favorable. Next is under labor. For the mixing department, we have $1,600 for labor efficiency variance, which is favorable. And under labor rate variance, we have 0. For blending department, the combined effect of the two variances results to unfavorable net labor variance of $2,120.
In mixing, both the materials price variance and the materials quantity variance were unfavorable. If they paid more for a better quality material in expectation of having a lesser amount of waste and spoilage, the strategy was not successful. It is also possible that there were price increases for material that were not foreseen when the standards were determined. The labor variances were more satisfactory in mixing. There was no labor rate variance and the labor efficiency variance was favorable. This means that given the caliber of labor they budgeted for, the amount of labor time needed to complete production was less than budgeted. In blending, there was a favorable materials price variance and no materials quantity variance. This indicates that they were able to use less expensive materials than budgeted for, while maintaining good control over materials usage. It is also possible that the price of materials of the quality that they had budgeted has declined. Blending's difficulties lie in the area of labor costs. Both the labor rate variance and the labor efficiency variance were unfavorable. If their strategy was to employ more expensive labor in hopes of having it complete production in a short amount of time, it was not successful.
Now, let's move on to the second and third items.
The journal entry for this problem is illustrated as follows.
Here are the other journal entries for this problem as a continuation.
So here is my answer on number 3, the balances of ending work in process in each department. This is the standard cost summary and the production report of Binghamton Beverages, Inc. The standard cost for the mixing department is $11, while on the blending department is $13. This is $24 in total. So now, here is the Binghamton Beverages Inc. cost of production summary. The total costs to be accounted for in mixing department is $77,000, while in blending is $73,345. In total, we have $150,345. So, the simplest way to calculate the ending work in process balance is through this. The mixing department has 2,000 units and 1/2 of it is completed. So, 2,000 times 1/2 times $11, which is the standard cost of the mixing department, is equal to $11,000. Meanwhile, in the blending department, there are 1,000 units and 1/2 of it is completed. So 1,000 times 1/2 times $13, which is the standard cost of the blending department, is equal to $6,500. We will add the mixing cost of 1,000 units at $11, that is equal to $11,000, which makes it $17,500 for the blending department. When added, the result is $28,500. In calculating the cost accounted for, we have the finished goods, which is $120,000, the work in process ending, which is $28,500, and the net unfavorable variance, which is $1,845. In total, the cost accounted for is $150,345.
Okay, so now we're down to the last two items of this problem. We're still on day 2. Oh no, a meow situation. For the next 2 slides, assume that Binghamton Beverages Incorporated sold 4,000 units at $40 each. Come on, let's continue!
Now, let's assume that 4,000 units are sold at $40 each, and we are asked to calculate the gross margin based on standard cost. In order to do that, we first need to find out the sales, which is 4,000 multiplied to $40, and the cost of goods sold at standard, which is 4,000 multiplied by $24. We subtract the two and we get the gross margin at standard cost, which is $64,000. Next is, we are asked to calculate the gross margin based on actual cost. In order to do that, we simply subtract the net unfavorable variance to the gross margin at standard cost, which we had calculated earlier. And we get the gross margin at actual cost, which is $62,155.
Oops! There's a follow-up question. Why does the gross margin at actual cost differ from the gross margin at standard cost? Well, the gross margin at actual cost is different from the gross margin at standard cost because the net amount of all the variances was $1,485 unfavorable. In a standard cost system, the production costs flow through the system at standard during the accounting period. At the end of the period, the standard costs must be adjusted to actual when preparing for the financial statements. Oh, meow! Tom still needs our help. A new situation is in. Let's help him.
Help Meow out. As the plant controller, you present the variance report above to Paul Crook, the plant manager. After reading it, Paul states, if we present this performance report to corporate with at large unfavorable labor variance in blending, nobody in the plant will receive a bonus. Those standard hours of 5,500 are way too tight for this production process. 5,800 hours would be more reasonable, and that would result in favorable labor efficiency variance that would more than offset the unfavorable labor rate variance. Please redo the variance calculations using 5,800 hours as standard. You object, but Paul ends the conversation with, that's in order. Meow to do. A question would be, what standards of ethical professional practice would Tom violate if he adhered to Paul's order? Well, if he were to follow Paul's order, he would be violating 3 of Institute of Management Accountants' ethical standards, which are, first, competence, which could be seen by not having to disclose the large unfavorable variance in blending accurately, concisely, clearly, and timely. Second, integrity. By choosing to follow Paul's order, he is engaging in or supporting something that could discredit his profession. And lastly, credibility. By fabricating the certain information, he is not communicating it fairly and objectively, and especially disclosing this information that can potentially mishap intended users' understanding of the reports, analysis, or recommendations. Oh, another question. How can Tom resolve this conflict? He could follow their organization's established policies on the resolution of such conflict. Once followed and there is no resolution applied, he will have to consider the Institute of Management Accountants' suggested resolution of ethical conflict. In this instance, submitting the information to the level of management above Paul should be sufficient to resolve this issue. The finale. The recommendation. Are you meow ready? I guess you're ready. Meow can you say? Regarding the expenses incurred in the mixing department, Binghamton Beverages Incorporation should be careful with the cost of their material. They must look for perfect suppliers of materials beforehand so that possible problems in the actual performance would lessen. As regards to the blending department, Binghamton should not spend too much expenses to the labor. Even though they wish to have a shorter time of complete production, they must think other ways or other alternative solutions in solving the problem. When concerning about having a situation where you are forced to manipulate some information, one must always remember to have the value of integrity, as this is very important in every aspect of our day-to-day living. Meow, congratulations! You have succeeded in helping Tom answer the required questions. Now, Tom can write on his diary again. Tom deserves a gift. Let's give him a gift. Treats for Tom's backpack. See you on next Meow Diary. Thanks for watching! You're now at the end of Tom's diary. Do you want to restart?